Welcome and good evening, everyone. Thank you, everyone, for joining us. Today, we have a topic on de-dollarization and its impact on gold prices. We have with us Mr. Manish Kathuria, President and Chief Business Officer at Kotak Securities. So, over to you, sir.
Thank you, Twinkle, and good evening to all our clients for joining in. Yeah, as you are aware, the subject on which we are going to be talking today is about de-dollarization and its impact on gold prices. Friends, we've seen that over the past few years, equity as an asset class has delivered very superior returns to an extent that a lot of our investors have kind of have a skew towards the equity allocations. And we've always believed that it's always the best strategy to get your asset allocation in place. So for a change on this webinar, we are going to be talking about gold as an asset class from an investment perspective and not really on equity. But having said that, all of us are aware on the way the markets have been behaving. The reciprocal tariffs announced by the US president did create a lot of disruption in the markets. We've seen markets shaving off a lot of, the equity valuations, etc. Before now, some sanity is prevailing. But one asset class which has been really holding on its own over the last few years, particularly in this year, we have seen gold as an asset class delivering superior returns. In India, of course, it crossed the massive psychological mark of 100,000 per 10 gram, which made Mr. Uday Kotak tweet that the performance of the gold really highlights that the Indian housewife is the smartest fund manager in the world. Would really make this as a very, very interesting proposition. So we have our research team from Kotak Securities who's there. Anindya Banerjee, who's going to be leading the talk for today, talking about the various variables and perspectives which one really needs to keep in mind before investing into gold. And of course, how we as distributors can help you in terms of getting that investment in place. Thank you for joining, and we look forward to make a insightful presentation today. Thank you.
Thank you, Manish sir. So moving ahead, team, I would like to introduce you to Mr. Anindya Banerjee. He is head of currency and commodity research at Kotak Securities. He leads the firm's research initiatives on foreign exchange, commodities, and interest rate markets. He has more than a decade of experience across for deep analysis and strategic insights into complex market dynamics. Along with Anindya, we have Shrikant Chauhan, who is head of equity research at Kotak Securities, and Mr. Vikas Bajaj, who heads the currency derivative piece. So over to Anindya.
Thank you so much. Thank you, Manish. Am I audible? Yeah. A very good evening to all of you and a warm welcome, because the gold market is really hot now. And over the last 1 year or so, gold has surprised everybody. And it's just not the last 1 year which has been quite phenomenal in gold. In fact, if I tell you a statistic that over the past 10 years, gold, if I take the ETF, if I compare the gold ETF with the Nifty ETF, it has actually matched the returns in the stock market. That's phenomenal, right? An asset where you don't have to sweat over earnings, you don't have to sweat over government policy, anything. That kind of a so-called lazy asset has given you a return which has matched the equity index return. So without much ado, let's dive right in. And as to understand what's driving the gold prices and how it's going to behave as per our expectation over the next 2 years or so. So gold and de-dollarization, it's a pretty heavy word, right? Gold we all understand, but what is de-dollarization? We'll come to that. hold on to your horses. So first, let's understand the gold in a new way. See, gold is one commodity, which is very little commodity, and it's primarily money. And it is like that it has been since time eternity. So gold is one kind of money, which in the hierarchy of the money, it sits right at the top. And just imagine an organization hierarchy. At the top is the senior management and the CEO. As you come down the pecking order, you have the number of people increases, but also their authority and power declines. Exactly the same with the global monetary order. Right at the top is gold, because this is one kind of money which no central bank and government can print. So it has no counterparty risk, no country risk, no credit risk, and no financial or social risk. So it in fact is a hedge of all risks. And then you come to the currencies, which are paper currencies, or we have a fancy term called fiat currencies. We have dollar, euro, rupee, yuan. You have the whole host of things, right? So and then you have the various other kinds of money. So here it's not an economics lesson, it's very simple. What happens is that when there is risk in the system, some kind of a major uncertainty, what happens? People go up the hierarchy and they try to grab hold of something which reduces their risk. Right at the top sits gold without, as I said, any of those risks. And just below that sits the US dollar, right? So the gold and de-dollarization is basically this fight between the gold and the US dollar. We'll dive right into what is dollarization and what is de-dollarization. But before that, let's first understand how has gold done over the last 1, 2, 5, and 10 years. As I said right at the start, that gold's return, if you look at the CAGR return, the CAGR return over a 10-year period, that's 1 decade, gold has given you a CAGR, the gold Bs, of 13%. The Nifty Bs around that period, around 12 to 13%. So, which basically means that if I take gold as a barometer of inflation, the true inflation of all of the Indian rupee, of the US dollar, the overall inflation, then basically the Nifty index has helped you to actually match the inflation, which gold itself has done that. Over a shorter time period, the volatility has been there in the returns, but over a 2 to 1 year period, gold has of course done much better. But does that mean that gold will do exactly this over the next 5, 10 years? That is something which we will discuss. But one thing is clear, that when we measure gold in terms of overall volatility, the volatility is much lower compared to equities, which means that it as a part of your portfolio will help you to not just reduce overall volatility of your portfolio, but at the same time, you will be able to achieve a lower volatility without sacrificing much return over a longer period of time, because this is one asset class whose whole objective is to basically compensate for the inflation in the economy, right? The global inflation, the domestic inflation, all of that. So what's happening? What's driving the gold prices higher? Because as you saw, a 13% CAGR, right, over 10-year period, that's a phenomenal thing. What has been happening is the massive buying by central banks. As you can see from 2008 onwards, it has been a hockey stick like a move in the central bank holding of gold reserves. And over that same period of time, the central bank's holding of US treasuries have gradually reduced as a percentage of the overall treasury issuance. Why? Because we'll come to the why, but this is a major reason what is driving the gold prices. This is the demand from where it is coming. And it is just not the central banks. Even the institutions are accumulating gold. The retail demand in the gold is quite strong. From time to time, due to price appreciation, it tends to go away, and then once the price stabilizes, the retail demand emerges. Like it is now, the prices have risen quite a bit in the last 4 months, so the retail demand has waned. But when you look at institution demand, central bank demand, that is phenomenally strong, and riding on top of that is speculative demand, and that's the reason why we have seen this kind of returns in the gold market. Now let's understand. We have understood what is the importance of gold in the global monetary hierarchy, right? So when there is risk, why people flock to gold? Because this is the true money, right? And we have also understood what is driving the gold prices, or rather, who is driving the gold prices. It is the central banks, the institutions which are driving the gold prices. But why are they doing so? That's the big question. So first we have to understand what is dollarization for us to understand what is de-dollarization, because de-dollarization is one of the major reasons what is that's behind the central bank accumulation of gold, and just not the central bank, even the institutions. So in a very if I talk about dollarization briefly, let's go back to 1971. So 1971, 15th of August, Richard Nixon of America, he declares that no longer the dollar will be converted to gold. So if you're holding a certain amount of dollars, you cannot go to any American bank and just say that take the dollars and give me physical gold, which you could do before 15th of August 1971. So we were in a gold standard. So gold acted as a disciplining mechanism for all governments around the world. Now that was the first day when basically that link was severed, and it was a shock to the global monetary system, because we have never experimented with a thing where the currencies don't have an anchoring commodity or an anchoring element, which was gold. And suddenly you had paper currencies which were not backed by anything. So the currency market was actually born, the currency trading was born in 1971, not before that. Actually, this may surprise a lot of people. So that was the time all these free floating currencies came about. So that was the time, was also the birth of the petrodollar. So around the 72, 73 was the time when again the US administration, along with the governments in the Gulf, they basically came to an arrangement where security for oil programs. So they will be providing security, but in return, their oil and gas has to be sold in dollars. So we started to move from a gold standard to a dollar standard. Now, one after another events happened since then, and that led to a situation where dollar became the important currency in the whole world. So suddenly America could actually print its own prosperity, because it can print literally unlimited amount of money and still maintain its exchange rate compared to other fiat currencies, because the other governments were buying these dollars which America was printing, the central bank, and as a result of which their own exchange rate kept on devaluing, right? So the dollar was able to maintain its overall exchange rate value that allowed the Americans to go out and spend, because you can literally borrow from the market and you can spend. So the government was spending, the consumers were spending. It led to financialization of Wall Street. Then the tech sector came up, and you had mega booms that led to more of the increasing dollar flows in the global economy, in the global financial system. So suddenly America had this one exorbitant privilege where it could print prosperity, whereas other countries had to earn the prosperity because they had to procure the dollar from the open market. Now, this was all going fine, but there were certain issues which were happening with the US economy. See, because of this ability to spend massively, the American consumers started to take on massive amount of debt. And between the 1980s, that's the time when the dollarization really took off, to 2008, the US consumer debt exploded, and it peaked with the debt crisis in America in 2008, which we are all aware of: the housing crisis, the consumer debt crisis, the bursting of the Lehman Brothers, Bears and Stearns, etc. So that was the peak debt which happened in the consumer balance sheet. And after the peak debt happened in the consumer balance sheet, the government in America started to take on the debt on its balance sheet. Because understand, right at the start, I said, when you look at the overall monetary system, when right at the top sits gold, but when you go below gold, you come into the paper currency format, the money can only be created as a debt. So, for example, a currency in circulation, the notes, is central bank liability. Deposits is commercial banks liability. So, money, as we understand, below gold is all debt for somebody, asset for somebody else. So, if you have to increase the money supply, if you have to increase the dollar supply, it needs to happen on the back of somebody's balance sheet, be it consumer, be it government. So consumers did that, but they went bust in 2008. Then the government, the US government, took that mantle and started to expand its balance sheet. And it went from 20 trillion all the way up to 38 trillion now, just within a span of 10 years in the US government, because they have been doing various kinds of programs, and the whole thing went berserk during the COVID times. So now you have been hearing a lot from the Trump administration that America is bankrupt if it continues to spend like this. We need to cut expenditure, all that. And that is important because if you remember when I showed this slide, that central banks are now acquiring more of gold and less of US treasuries. So if US is going to keep on issuing so much of debt, the government debt, because its balance sheet is expanding, right? Then who is going to absorb it? If the other countries don't absorb that much amount of debt as much as getting issued, what happens to the demand and supply? There's going to be more supply and less demand. The prices will come down, which means the yields will rise. And we have seen, very interestingly, last 6 months, the yields in America have gone up in spite of the fact that we had a stock market crash. Generally, you tend to see a situation where when the stock market it crashes, yields, or the 10-year yields, the 30 years, which means the US Treasury bond yields, they tend to fall. But that's not happening because there is a structural shift. Now, at the same time, if you look at the chart on the left, so this chart, which is basically the current account chart. So the CAD, which I have written. So what does it signify? It signifies how much of net demand American economy is pushing into the world. Because whether it's consumers, whether it's government, finally, how much of how much of demand is getting pushed into the economy. So America currently is running a current account deficit of around 4%. It used to be much higher, but at 4% of GDP, the GDP is around 30 trillion. So 1.2 trillion dollars of demand, net demand, is flowing into the world economy. So it's using the privilege of dollars and able to spend so much, which is absorbed by the BRICS plus and other countries, right? And plus, at the same time, because of dollarization, what has happened is America has become largely deindustrialized, because when you have a single country reserve currency, your overall cost of production and cost of living increases significantly. And when that happens, it is unviable to produce or serve from America. So then America becomes the consumer, then China becomes the producer, or India becomes the service provider in a very simplified way. So that led to a situation where jobs were actually shipped out. So the wealth grew significantly in America in dollar terms, but it was accumulated with the very few right at the top, or what we say, the inequality in America surged over this period. So on one hand, you have a very unequal society that is causing enormous social strife, and that is causing very significant political changes in America. And that's the reason why we have seen the first Trump administration and now the second Trump administration, because as they say, the middle America is revolting, because that's where the deindustrialization has hit hard. So when you have such unequal society, there will be social ramification. That's where America is coming to. And now because of this, so you have first strike was the consumer debt peaked. Second, now there is a talk of that the government debt is at its peak. Third, there is a huge talk that you cannot keep on just importing so much of goods and services without creating jobs in America. So if all those things are getting impacted, then this particular cycle of dollarization is totally disrupted. Because when you are the owner of the single country reserve currency, you need to have open borders for goods and services, for financial capital to flow, for people to come in, and also for your role as a global security provider, or as you call the American security umbrella. Now, America is reneging on all these fronts. They are actually pulling back on all these fronts, and it's not new. It also happened with Britain when the UK had the single country reserve currency during till the 1930s. It also behaved in a similar manner during the fag end of its cycle. So we are seeing a similar thing play out with the US and the US dollar. The telltale signs are there, as you can see. Every part of that wheel is getting attacked. The America First is basically means that America is saying that I want to create jobs. So how do you create jobs? You have to basically produce and serve your own demand. Now it's easier said than done, because it means that you need to change the whole globalization process. You have to also change the way the currencies function, how the cost of labor is. Those are different aspects of it. But in a nutshell, it basically is changing the whole dollarization process. It's reversing it. That is what we term as de-dollarization. Now, when that happens, what happens is, if you go back to this hierarchy, when the second most important money in the world, which is US dollar, the doubt is arising because they are no longer wanting to be the global reserve currency, not because they are saying it that, but they are acting that way. Because when they are saying, I'm going to put high tariffs, and they are already putting high tariffs on goods and services. So open border for goods and services is being attacked. When Donald Trump is saying that he wants to go back to those heydays of pre 1940s, when American administration used to earn a significant part of the government revenue from tariffs, and income taxes used to be low. It's all that is great, but at that time, America did not have a single country reserve currency. So if you look at the actions, and if you connect the dots, it's clear that there is a flux in the second most important money in the world, which is the US dollar. So when there is a doubt on the second most important money in the world in the hierarchy, what happens to the investments? It flows right at the top. So that is gold, because gold has, as I said, has no counterparty risk, has no credit risk, has no country risk and social risk. It is widely acceptable as a medium of exchange and a source of savings. So that's the reason why gold is seeing this structural shift. And it's not happening now. It's only accelerating now. It has been happening for over a decade, which we saw with the central bank accumulation of gold, the prices of gold. But over the last 3-4 years, the price appreciation has been phenomenal. For example, in India, if I go back to 2021 and now, prices have almost doubled in gold. So currently around 95,000, 96,000, it is almost 100% higher. So with this, we come to the point, what's our expectation of gold and what's our expectation of silver? But when we are talking about gold and silver, we cannot be oblivious to the fact that it is impacted by the currency exchange rate. So the gold, we are anticipating that we had a fantastic run in the gold prices, right? So we still expect the gold prices to continue to do well because of the structural aspect which I highlighted. And we expect it to even head towards 110,000 over the next 12 to 18 months. So which means from a portfolio allocation perspective, gold is recommended to be around a 10%, 10-15% of your portfolio. When I say gold, some people might also look at silver. But remember, if I am comparing gold with silver, let's take an analogy. Gold is like the large cap. Silver is like the small cap. Now, silver has an added attraction that it is half gold and half industrial metal, because it is half of the demand for the silver comes from industrial applications, and a lot of the new economy industries like electronics, EVs, the solar panels, etc. They are using a lot of silver, and this particular market is in a deficit for the last 3 years. So silver also has a compelling case, but again, the silver market is very volatile. Compared to gold, the volatility is higher. So accordingly, the allocation needs to factor that in. So it is better to allocate more on gold and less on silver, but you can have a mix of both over in your overall portfolio, so that the overall volatility comes down. You have an asset diversification. Now, coming to USD INR, because as I said, we are our talk on the gold and silver is not complete without talking about the exchange rate. And our expectation is that the USD INR is going to see a range bound kind of a movement, because RBI is expected to be there, quite vigilant, trying to contain volatility, and they have done a fantastic job over the years. We expect 84 to 87 in the USD. But having said that, we need to be aware that global situation is flux. We already have the geopolitical risks in the horizon. So we have to be very flexible and quick when it comes to currency markets. But we believe, because the RBI is going to be quite vigilant, they will be able to contain it more or less in this band of 84 to 87, let's say over the next 6 to 9 months. And that means that the impact of INR on the gold prices might be limited. It will be largely driven by what happens to gold in dollar terms. So with this, I'll open the floor to questions. Questions are coming in. Just a moment. The first question is, I want to buy gold for intraday. Can I buy? Okay, so let me make this question a little broader, because this is a very important question. Okay, we understood what is gold, what is actually driving it. We have got a price forecast. The fourth important, how can I take exposure in this, right? So gold, it has several avenues of taking exposure. The predominant avenue are ETFs. We also have sovereign gold bonds, but currently it's not getting issued. But that's another instrument, because the ETF market is extremely liquid. 60,000 crore close to AUM is there, and there are plenty of ETFs which are traded in the market. And the third option are gold futures on the MCX. But again, the basic difference between an ETF and a futures market is that in an ETF, it's a cash market. So you pay 100% of the amount, the exposure which you are taking. In the futures market, you pay only a fraction of it. Let's take if the margin on gold futures around 15%, you pay 15%, and keep the rest aside. But you also have to take care of the mark to market, because it's just like the equity derivatives, right? Every day you have a mark to market, so that will be there in the gold futures as well. So which kind of people prefer the ETF, and which kind of people prefer the futures? Predominantly, the investors prefer ETF, because it is a very straightforward and a plain vanilla way of taking exposure in the gold market, and there are no complexities in it. But when it comes to futures, the first thing which you have to keep in mind is that it has an aspect of mark to market, which means every day the cash flow will go in and out of your account. You need to maintain that much of cash. The advantage is that you just have to pay a fraction of the amount upfront as the initial margin, and then the maintenance margin comes into fact. So which of the players who tend to play it are generally more sophisticated players who want to take short to medium term price views. And some people also like to do option strategies and all that. But again, for investors, we would recommend that you go through the ETF route. If you're a more sophisticated investor, then you can explore the derivatives market. The second question is, what percentage of allocation of gold is recommended for medium to long-term portfolios? Generally, we recommend 10 to 15%. And as I said, some people like that to be completely, say gold. So 10% of your entire portfolio is gold. Some people like a mix. So you can have a mix because silver prices have not risen as much as gold, and silver has that compelling case because it's a half gold and half industrial metal. So you can have some silver in your portfolio. So overall allocation stays around 10 to 15%. And so that's it with as far as the questions are concerned, because the other questions are repetition of that. But before we conclude, the most important thing that we have to keep in mind is that the gold prices have increased significantly. That's the reason why it is now the most buzzing word. Over the last 3-4 months, we have seen a significant jump in the gold prices. So when you're entering this kind of a market as an investor, it is very important that you don't make a bullet investment. Better you stagger your investment into tranches. So that's the reason why an ETF is a good way of going about that. You systematically invest in this market so that when the gold prices correct or come down, you're able to take advantage. The same applies for the silver, because there are also silver ETFs. So you can do this same thing in silver, that you can systematically invest in both gold and silver. Okay, we have another question. Hi, sir. If China-US trade deal done on tariffs, how much can dollar strengthen and the rupee depreciate? So it's a question on USD. Vikas, would you like to take this?
Yeah,
Vikas, are you there?
hi.
Yeah.
Yeah, I'm there.
Yeah.
So on the question that, if US and China trade deal happens, by how much dollar can appreciate vis-a-vis rupee. So I will first share my view on dollar. Obviously, I mean, historically, if we see, dollar has always been considered as a safe haven asset. And whenever there has been, elements of uncertainty, crisis, dollar tends to, strengthen. But this time, it has not happened so. Obviously, because, the way Trump is looking to change the global order, there is a trust deficit kind of creeping in. And as a result, dollar has lost almost like 5 to 6% since maybe around from the last week of March to till today. So now, if in case there is a truce between US and China on the trade, I think probably dollar will tend to gain some of its lost ground because still, I mean, there is an element of trust deficit, but world doesn't have an alternative as of now to completely shift away from dollar, given the way it is, entangled across the global financial system. So from that perspective, I think that dollar will tend to strengthen if in case there is some bit of softness between US and China on the tariff front. With respect to rupee, Anindya has covered the view. It is likely to trade between 84 to 87. So that's the way we are looking at it, on dollar front and rupee. I think, Anindya, there is another question with respect to, how much percentage gold can correct if in case there is a truce between US and China. So if you can take that.
Sure. Thanks, Vikas. In fact, the fall in the gold prices from almost 1 lakh to now around 94,600 or so. So that has happened because of the news that America was trying to back off from a very hardline stance as far as the tariff war is concerned with China. So if we see further rollbacks in the tariffs between China and America, we could see a further fall in the gold prices. Because interestingly, I'll share one statistic. If I look at the gold market now, I'm talking about in INR terms. Sorry, in dollar terms. So gold has not corrected by more than 10% for the last 575 to 580 days. That's more than a year. So, and the last time it had this kind of a long parabolic run was zero, which means this is the first time gold has seen such a long, say, long period of price appreciation without a 10% fall. So it just shows how stretched the market is. That doesn't mean it's going to collapse tomorrow. No, because the long-term picture for gold is very bullish, but it means it creates an opportunity for investors. We will get these correction in prices. That's the reason why I said that you have to get into the market in a staggered manner. Using the ETFs and take advantage of of these price corrections. Now, how much can it fall? As we said in the price outlook, 88,000 on the downside, 88 to 90,000 could be the worst case which we are looking at in gold. So 88,000. So anything it comes around 90 or below, we would advise that accumulation. You can increase the pace of accumulation in gold.
So Anindya,
Yeah.
I just want to chip in with respect to the how much gold can correct. See, it is very difficult when we look at the asset from the long-term perspective. But just to kind of add here, if we look at the historical data of gold over the last, say, 50, 60 years, we can clearly see there has been, this is the third bull run which we are seeing in gold. The first bull run which we saw in gold was in 1970s, which Anindya rightly also incorporated in his presentation. It happened after, Nixon saw, which we call, after he took dollar off the gold standard. So if you see on the chart, the first bull run happened in gold in 1970s. The second bull run started in 2001 or 2, just post dot-com bubble. And in both the previous bull run, we saw significant upside in gold. Now, I don't want to put a number because if you go and see that, from the start of the bull run to the, top in that trend, it was like, in multiples of factor, right? I mean, 3x, 5x kind of number. Now, this what we are anticipating that with the post-COVID, we started seeing kind of price appreciation in gold, which accelerated in the last 6-7 months with the kind of decisions being taken by US President Trump. There can be a significant price appreciation still there. But obviously, there has to be mean reversal, because even if you go back to the old charts, you will see there has been significant pullbacks as well. So structurally, gold remains in a bull run with the kind of changes or the global reorder happening. So from that perspective, if you allocate 10 to 15%, I think it should pay off well. That's the way we are looking at it. So it could be the third bull run which we are seeing in gold. I just wanted to add that. Yeah.
Absolutely. Absolutely. In fact, the questions which we have are more or less in line. You've already answered it, but I'll just touch upon. We have a question which says how much to allocate in silver. See, one thing, keep this thing in mind that, as I said, gold is like a large cap, silver is a small cap. So which means your risk appetite has to be much higher when you're allocating to silver. So it is advisable that though we see a much bigger scope for silver prices to rise more than gold over the next 3-4 years, if that's the horizon we have, or you are having, but the volatility is also going to be much higher. So it is better you keep the principal allocation in gold and keep a side allocation in silver. So that can give you exposure in both the instruments. So, and we have the ETFs as well, and there are plenty of liquid ETFs. So you can select the ETFs based on the expense ratio and the liquidity, because if you are because you also have to consider the liquidity, because that decides the impact cost. So there is another question: if I am in 90% profit, should I do profit booking? I presume you are referring to gold, right? So see, that depends on your overall portfolio allocation, because it's fantastic that you have invested at the right time, so you have been enjoying this phenomenal ride. But to be completely out of gold, the question then comes, okay, I'm going to sell gold from my portfolio allocation and put that money where? If your answer is I have found great businesses to invest in equity, that's a call which you have to take. But the question is this, that when I am making a portfolio allocation, if I am selling something, have I found a better alternative for that investment? So that's from an investor asset allocation perspective. If you are a trader, you have got a nice 90% pop. Yes, you can say take some money out of the table, but our view is that don't go zero, because the global situation is very fluid, and it's our understanding, it's our view is that the trade war is far from over, because de-dollarization, we are expecting that because the other aspect of de-dollarization is deglobalization, which I explained. So that will play out over the next 4 to 5 years, 6 years, right? So over that period of time, we could see several episodes of these kind of trade dislocations. So the trade war is far from over. We could be enjoying a brief period of calm. So to expect that the storm is over, possibly not. So to be completely zero on gold, it is not advisable. So you can definitely keep taking profits, take an advantage of the price dip and enter again. But you have to time your entry as well. So that is very important. So I presume we don't have any further questions. So we'll wrap it up. Vikas, anything you have to add?
I just want to add, when we are looking at commodities, and especially in the background of, what is happening on trade front, just kind of think through that the way everyone wants to kind of industrialize themselves, right? I mean, US is talking about you want to manufacture, come to US and do that. Same is the case with us also, India and maybe other countries as well. So if every country is looking to kind of, build, factories, just look at, think that, how the commodity prices will behave. So gold and silver, definitely they are very close to the monetary side of the thing. But, if you look at copper and, the base metals, what we talk about. So if everybody wants to set up the factory, then obviously you require commodities, right? So the way I am looking at it, over the next few years, even if the world settles to a base level of tariff, which US has talked about, 10% for all countries as of now for 90 days. I think the commodities on overall basis will remain bid, because if we want more companies to come and set up factories, if US wants more companies to come and set up factories, the demand should remain strong for all base metals on overall basis. So I just wanted to kind of add that point here in India.
Yes, yes. So with this, we'll just conclude this webinar. Thank you all for attending. It was a fantastic opportunity to share our views with you. I hope you all enjoyed this particular interaction, and we hope to do more such interactions in the future. So with this, we conclude. Have a fantastic evening ahead.
Thanks everyone.